Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It's Monday morning, July 17th, and this is The Talking Point. What we have this morning, this is the futures market, of course, is market looking as this may have a difficult open. The market has done extremely well, as everyone knows, and then you reach a point where the market digests the gains and just waits for yet another catalyst to climb higher. So even if we close in the red today, it is part of the, how do I say this, the part of the trajectory for the market, especially during an earnings season. And this week, obviously, the earnings season begins again. We're going to have more and more banks, and then it spreads out, and we move towards, every single sector in the market. But in terms of last week, I want to go over this. We had a period where the market rejoiced over the fact that the CPI report, Consumer Price Index report, showed inflation pulling back, and even in the core, that so-called super core, that's the part that is ex-real estate, but it is also starting to untangle. It doesn't mean that it has come down. Inflation is still above the Fed's target of 2%, but it is starting to untangle. Regarding the commentary from the Fed speakers, of course, a number of those who are considered more hawkish are saying, you know what, we need to raise rates again and maybe even a second time. Even those who are on the more dovish side have acknowledged that inflation remains still too high. So this is going to be, I think, truly a data-dependent period where the Fed determines whether or not July 26th, which by all measures, the market sees that it is going to see a rate hike. But then the other question is what happens on September 20th. That's a long way to go. And the Fed has said over and over again, they are data dependent. So what we're seeing is July 26th. Right now, the Fed funds futures market is looking above 90%. And the Fed has done nothing to dissuade the market that won't happen. So that's what we expect to see. The question will be what they say in the statement and also what Chairman Powell says at the press conference. Right now, the Fed is in the quiet period. And for the market, that's actually a good thing, so it doesn't have to jump from headline to headline. Overseas, the European markets are down, and one of the reasons is that China has come in with disappointing numbers yet again, and it looks as though the government at this point is moving away from the idea of maybe even fiscal stimulus, but if they do, it's not going to be a very, very heavy, expensive project that they would come in on the fiscal side. What's the fiscal side? That is what the government does as opposed to the monetary side, which is what the bank, the People's Bank of China does. And they will continue, most likely, to lower rates, target rates. And the other thing is we have to wait until we hear from the officials, and they're going to be meeting in China at the end of the month and determining what they're going to do for the second half. So again, a lot of this is speculation. That said, the disappointing numbers in terms of GDP, disappointing numbers in terms of what exactly are they going to do to help in terms of the unemployment situation. Those numbers have climbed higher, and these are just the official numbers that we are getting. So again, a lot of global growth, the ramifications of a strong growth in China, actually the ramifications are strong for the rest of the world, actually, including the United States. But if they don't do anything to help propel growth, it is going to disappoint their major trading partners, which a lot of them are actually in Europe. So it just has a dampening effect on the global economy. In addition, here in the United States, the banks that came out last week, the large money center banks, very upbeat earnings, top line, bottom line, and in many ways the guidance was solid. They did, however, offer their concerns about what the Fed is going to do, and the overall effects, the lagged effects on the economy of all of the rate hikes. But nonetheless, Jamie Dimon from J.P. Morgan came out and he said, the resiliency of the economy is there, and that is exactly what we're seeing, a resilient economy. Again, the questions always are now, if the Fed raises rates on July 26th and suggests they're going to raise rates again after that, at what point does the economy start slowing down in a more meaningful way? And that is something that, is being debated as to whether or not this Fed could actually engineer a soft landing. Or if there is a recession down the road, is that going to be a mild recession, a mildish recession? So all of these are questions that the big banks have posited in terms of what they see ahead. But it's no different than, again, what most economists and strategists are suggesting about the economy. It's unknown, and therefore you can have quite a bit of conjecture. The other thing about this week, we're going to pay very close attention to what the companies are saying, because the market is richly valued at this point, 19 times, and it's not, the higher the Treasury yields are, the more these companies have to really perform well. When you have rates at 1%, as we did for so long, you could have higher valuations. But when rates climb higher, and even though it's not over 4%, they pulled back below that on the 10-year, it's still higher than what we had a number of years ago. So this is important. So companies have got to come out and they have got to offer a positive or solid earnings report. The question for the market is, if they come in and say, well, things weren't that good, we're going to cut costs, then the question becomes, does the market accept that, right, and give them the benefit of the doubt? And more importantly, do we start to see more companies saying they're going to cut costs and cut headcount? So that's what we're going to be paying attention to as we go through the broader earnings season. The other aspect of this is, are we hearing more about inflation? Now, the inflation talk has eased a bit. The National Federation of Independent Businesses, the report that came out last week, these are the small business owners, they still are, talking about inflation, but not as much. But it's still a concern. A good portion of them, and this was very good news, are saying they are not going to raise their prices, although about 30% of them in the survey said we may have to. We may have to, because wages remain high. And that's another issue in terms of why the Fed does focus on wages. So all told, we're in a good place right now. The market is seeing the Fed is coming toward the end, maybe not the end, on July 26th. It's probably not a one and done, but nonetheless getting closer and closer to that terminal rate. This week, again, full spectrum of earnings. We're paying attention to the banks. Why? Because the banks have a very good perspective on the housing market, a good perspective on loans, the profile of companies taking out loans. Are they defaulting? Are they late in their payments? Same thing about the retail loans for the consumers. They also have a good focus on credit cards. If they are associated with a credit card, they will give us a glimpse of how we are spending money and how we are paying back. Is it on time? So you get a very good picture of the overall economy. And by the way, as we get to the regional banks, we will have a couple this week, but when we get deeper into the smaller banks, but the regional banks, we get a much more granular picture of the economy. And so far, again, so far so good. This week, in terms of economic data releases, there will be a number regarding the housing market, existing home sales, for example. But, we always seem to get a number of those housing-related data releases right after we get, some of the Case-Shiller, for example, where we did see housing prices come up in a number of the cities. So that is good news as well. Also this week, we're going to have retail sales. And if you ask me which is the most important data release this week, I would look at retail sales. Why? Because we know that the U.S. consumer is more deliberate in our spending. We are 68% of GDP. And when GDP is trending at about 2.2%, that spending really does matter. So just recently, there was a report out from Deloitte, that's the consulting firm and also accounting firm, suggesting that the U.S. consumer is going to be spending less on back-to-school sales, being more careful on back-to-school sales. Why do I mention this? Because back-to-school sales are very often an important precursor to the very important holiday spending. And that and I do need to point this out, though. It doesn't necessarily follow that we won't be spending as much as we did, say, last year, but that is something that gets factored in to how the consumer is looking at allocating and budgeting, right? And that's very important. So we want to see what retail sales are looking like. I do want to also mention that we are seeing Americans buying more vehicles, new cars, and those numbers have gone up. That's a big ticket item. And therefore, if you're starting to pay and didn't pay cash for that car, that vehicle, you are paying a monthly charge along with perhaps your mortgage. So it stands to reason that folks may be more careful with back-to-school sales. But just because, these surveys come out doesn't mean that is the way it's going to be. I'll also add this. After we do this one, it won't be just holiday sales. It will be Halloween sales, because that also is an important precursor to the bigger holiday spending pattern that we look for in terms of the health of the U.S. consumer. So we have that coming out, the retail sales, a spectrum of housing-related sales, including existing home sales. And also, I do want to point out that we'll start the manufacturing reports again. Manufacturing is still in decline. Manufacturing is still in contraction, and it is recession-like. So we'll start off with the Empire Fed survey. That is the manufacturing report that comes out from the New York State manufacturing perspective. We will look for new orders. We will look for hiring expectations, and we'll look for general optimism or lack of optimism on future earnings. And then the Philadelphia Fed survey comes out as well this week. That one is extremely important in that it has a higher positive correlation with the rest of the country, with the heartland, in terms of manufacturing. But there, too, we will look for new orders, we will look for hiring expectations, and we will see whether these numbers are higher or lower than last month. Remember, we're looking for a transition, a turning point in terms of manufacturing, because it is in contraction. There's no other way to put it. That said, and this is important in terms of the retail sales, when we look at the Institute for Supply Management report on consumer spending as it is encompassed in the services part of the economy, the headline number was well above 50. It was about 53, telling us it is an expansion territory. So overall, the economy remains resilient, but it is also based on an unemployment rate at 3.6% and the labor market still solid. Initial unemployment claims have not risen. They remain actually fairly level. The question now is, again, I want to repeat this, as we go through the earnings season, do we hear from one company after another suggesting they need to cut costs and cut headcount? So that is going to be something that we're going to be watching in addition to the guidance. The guidance is crucial at this point, because when we're growing at 2.1, 2.2%, it's still solid, but as you know, it is not as solid as, say, growing at 3% or even 4%. So we want to pay attention to what their guidance is. What are they hearing from their own clients? What are they hearing from their own customers? That's what the market needs to hear this week. So take good care. Have a very good week. We'll be back next week. Thank you.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.